Have you noticed how strange gold has been lately? It's not crashing, and it's not exploding higher either. Gold is moving sideways very quietly. And this kind of silence usually shows up before major moves. Most people get bored here, most people lose patience here, but that the market doesn't care about emotions. The market only reflects capital flow and big money. It moves in silence. In this video, I want to share my personal perspective on where gold may go in the next few days. Why gold may trade between $4,700 and $4,800, why accumulation could last to 2-3 days, and why a return toward $5,000 or even $5,300 or higher is still very possible. Before we go any further, I need to be very clear. This is my personal perspective. This is not investment advice. I am not telling you to buy or sell. I am not predicting prices for short-term trades. This content is for educational purposes only, and to share how I personally view the gold market. Gold is suitable for long-term wealth preservation, not for short-term trading. If you are looking for fast trades, this video may not be for you. But if you care about protecting purchasing power and thinking long-term, then let's continue. Right now, gold is showing reduced volatility. Price swings are getting smaller. This is a sign of temporary balance. Buyers and sellers are in a tug-of-war. Neither side is fully in control. In this environment, gold may trade within a range around $4,700 up to about $4,800. This is not a weak zone. This is an absorption zone where selling pressure gets absorbed, and the market prepares for its next move. Many people see sideways price action and assume gold has lost momentum. But history tells a different story. Sideways markets are often accumulation phases that come before major breakouts. Breakouts most people are not positioned for because they left early or only come back after prices surge when risk is much higher. Sideways markets don't hurt patient investors. Impatience does, and markets always punish impatience while rewarding discipline. That's the nature of financial markets, and gold is no exception. In fact, gold is even more demanding because it moves slowly. But when it moves far, and it moves fast. This pattern has repeated many times throughout history. In the short term, gold may simply need more time, around 2-3 days, to complete this accumulation process. This phase tests patience. Late buyers start doubting their decisions. Early sellers begin second-guessing, but institutional money has no emotions. They buy gradually, without pushing prices higher, without creating noise, quietly absorbing supply. That's why volume doesn't explode, but price also doesn't collapse. This is a very specific market behavior that often appears before trend shifts. If you only watch short-term charts, this looks boring. But if you zoom out, this phase becomes very important because major positioning happens when the market is quiet, not when headlines are loud, not when prices spike, but when nobody is paying attention. That's usually where risk is lower compared to chasing momentum. And again, this is just my personal perspective, not investment advice. Everyone's situation is different, and responsibility always stays with the individual. And simply sharing how I observe markets and how I stay disciplined during periods that seem meaningless, but often turn out to be critical. Markets don't reward intelligence alone, they reward consistency. And gold is a test of consistency more than almost any other asset. If you can stay patient here, you're already ahead of the crowd by a wide margin, even if it doesn't feel like it right now. Once accumulation is complete, gold rarely moves slowly, repositions quickly. If demand continues, a move back toward $5,000 is absolutely possible, and if momentum builds, the $5,300 area or even higher should not be surprising, because the fundamental pressures remain. Inflation hasn't disappeared. Global debt keeps rising. Fiat currencies continue losing purchasing power. Geopolitical risks remain elevated, and trust in financial systems is not what it used to be. Gold doesn't react to daily news. Gold reacts to systemic stress, and that stress is still building slowly but persistently. When pressure reaches a breaking point, price doesn't ask for permission, it simply moves. That's when late attention returns. Media coverage increases, and fear of missing out appears, but by then risk is already higher compared to accumulation phases, like the one we may be seeing now. History repeats itself, only the players change, and the background looks different. Human behavior stays the same: greed during rallies, fear during pullbacks, and boredom during consolidation. Markets use these emotions to transfer assets from impatient hands to patient ones. That's not manipulation, that's market structure, and gold has followed this pattern for centuries, not just a few cycles across different systems and different currencies. So, if gold feels boring right now, ask yourself whether that boredom is actually protecting you from emotional decisions. Gold doesn't promise quick riches, but it has helped many people avoid getting poorer over long periods of time. That is its core function. Gold is suitable for long-term wealth preservation, not for short-term trading. If you want excitement, gold may disappoint you, but if you want durability, gold has always played a role. Once again, this is my personal perspective, not investment advice. I don't know exactly what will happen, nobody does, but I do know this: markets reward people who understand their position and accept waiting. If this video added value for you, please hit the like button and subscribe to the channel for more long-term gold market insights focused on preservation, not hype. Now I'm curious, do you see this phase as boring or as an opportunity? Let me know your thoughts in the comments below. I genuinely want to hear your perspective. Thank you for watching until the end. Stay calm in an increasingly unstable world, and remember, the most important asset is not just gold, but mindset, long-term thinking, discipline, and independent judgment. I'll see you in the next video. Thank you for your time. Thank you for your attention, and thank you for thinking instead of following the crowd. Take care and stay patient.